Good evening, everyone. Good evening. Can I have a quick sound check? Get sound issues out of the way. Can I get a yes if you guys can hear me clearly? Can you guys hear me? Clear? All right. Right. All right. So let's get into the session today. Today's session, okay, we called to discuss about the volume weighted average price and the volume point of control, two elements of derivative trading, which I feel are extremely important for us short-term derivative traders in the market. Now, my definition of short term is anyone who trades between a 1 minute time frame to about 5 to 10 day time frame. That's my definition of short term trading. And we are at VTrender, to use one word, obsessed with the finding edges to assist in our short term understanding of information the markets are giving us. So there are lots and lots of tools which are available to dissect the information the markets keep giving us. And it's not actually the tool, but the way you can interpret the data which that tool is giving is all that trading is all about, right? So today we're going to be talking about volume weighted average price, and we're going to be talking about volume point of control. And I'm sure a lot of you are well versed with both these terms. But what we'll do is we'll break down this concept of VWAP and VPOC and see how it can best help us to make better trades for ourselves, to assist us in our trading requirements, and to find a better edge as we go about the business of trading. Okay, so what I intend to do is we'll take a lot of breaks, and we'll make it into a more of a Q&A format, and I'll talk to you about what I understand about these two elements of VWAP and VPOC, and I'll ask a lot of questions also. And if you have any questions, please feel free to ask in the comments, and we'll pause and we'll take all of your questions as well, right? So to begin with, VWAP. VWAP, everybody knows what it is: volume weighted average price of the market. VWAP is volume weighted average price of the market. Now, when I say average price, there is a difference between a volume weighted average price and what is generally an average price in the market. So everybody knows, an average price is the sum of all that is available divided by the number of elements which are there, right? So assuming there are about two traders in the market, only two traders in the market, and assuming they trade the Nifty, and they trade, let's say, about 10 lots each. And Nifty, because of the trade 10 lots each they traded, moves from 21,880 to 21,890, a 10-point move. Okay, between those two traders, you can say the average price of trade was 21,885. So that's the difference, 21,890 minus 21,880, the price from where it began to the price where it ended, divided by the number of players. In this case, there were only about 2 players in the market, and we say the average price was about 21,885 in the market that day. So if that is the average price, what is the volume weighted average price? So volume weighted average price will give more weight to the person, okay, who is trading the bigger lots. So in this case, because okay, both of them are trading 10 lots each, and between 21,880 and 21,890, you can say the VWAP is the same thing as the average price. The VWAP of these two traders in the market and the movement of the trade would still be 21,885, only because both of them trading 10 lots each, right? But let's say price moved from 21,880 . So let's say price moved from 21,880 to 21,890, same example. So that's 880 here, 21,890 down here, and say one of them traded 2 lots and the other traded 10 lots. Okay, now because okay, there is a difference okay in the volume okay which is traded by both traders, the average price is 21,885, but the volume weighted average price will be different. Now we have to find out where trader A traded his 2 lots and where trader B traded his 8 lots. So in this example, if trader A traded his 2 lots at 21,882 and trader B traded his 2 lots at 21,888, okay, 6 points above 21,882, and price moved from 21,880 to 21,890, the VWAP, because okay, the higher volume of trades was higher, will be higher than 21,885. It is going to be closer to that weight, to that value of 21,887, 21,888, because more volume is coming to the lower side. Conversely, if more volume was traded by trader A, he traded 8 lots, and trader B traded only 2 lots at 21,885 or 21,888, then the average price okay would be lower. The volume weighted average price would be lower than 21,885. So what does this do is it tells us that within that VWAP, that number okay which is given to us, we know if the VWAP is rising, that means okay, more aggressive volume or more volume is coming in above the average price of trade. And if VWAP is dropping, we are getting more average price, more average weighted price, more volume coming in below the average price of the trade. So if you get a situation okay where price is moving in the market, okay, and the VWAP is not rising, it is telling you okay that rise is coming up on lower volume. It's not coming on heavy volume, right? Now bear with me. The reason okay I'm stressing this particular point is because okay we get a number of ways okay in which we interpret the VWAP of the market, right? Now in all our charts, I've got a market profile chart over here, and I've got an order flow chart over here. We give a very simple explanation okay to where okay the VWAP should be. So in the market profile chart, wherever okay you see this color green, this is the VWAP. Okay, so in the order flow chart okay it will come up as this a green color line, and in all of our charts wherever okay you see this green, even in the order flow bar chart, this color green is the VWAP of the particular bar. So you get a VWAP of a day, which is this particular full session. This is the VWAP okay of the day, again the green color. You also get a VWAP of the bar, volume weighted average price of the bar, and at every point in time it makes sense okay for us okay to keep looking at this VWAP, this green line, and find out okay where the volume weighted average price was. Now as a rule, Okay, the general rule of thumb is if price trades above VWAP, you can say that the buyer is more in control of the market. Okay, now this is a bias statement. This is not a trading strategy. Okay, but it's a bias statement. Okay, that means, okay, you can firmly assume that the price can go higher if the market is placed above VWAP. And conversely, if price starts trading below the volume weighted average price, okay, you can say that the seller is in control of the market. Right now, if you just had to look at this particular full day session, and I'm looking at the market profile Nifty of today, the 19th of March, and this was the VWAP price. Okay, and if the market has been spending a lot of time below the VWAP, can you now say with what we just quoted as a bias statement that the seller was more dominant today because price was below the VWAP? Yes or no? Anyone? Would you agree with me when I say that because in the Nifty, most of the day today was spent below the VWAP of the day, can you now say that the seller was more in control of today's trade, Tuesday's trade? Let me get a show of hands if you agree with me. Anyone? Yeah? Would you agree with me? Yes, no? Okay, let's take this along, guys. We basically want to have a concrete discussion over here about how to agree. So when you see a chart and you see a VWAP line, okay, the first thing, okay, you note is where are you trading now in relation to that VWAP. So this is my VWAP line in the order flow chart. Okay, and I can see this entire price zone is trading below the VWAP, volume weighted average price. That means, okay, we moved below 21,957 right up to about 21,868, 870 today, and the entire price movement was below the VWAP line. Now I am looking at this and saying the seller is in control. Right now, if the seller is in control, what is the trading strategy I need to employ? Okay, when I know that the seller is in control, I can either short calls or I can buy long puts. Okay, now you can take it a stretch further and you can say at a certain point that you can buy calls in the market, and I know a lot of traders also do that. There's nothing wrong with that. Okay, if you follow a rule and a strategy, okay, you can still get a move back to this VWAP, and there would be conditions in place for you to recognize that move. Right, so a lot of traders I know, okay, that they go out there and they say, I don't believe, okay, that if the market is below VWAP, we should sell the market, right? And they take contra trades and they go long in the market. But know one thing, when the market trades below VWAP, okay, the seller is in control. That's the thumb rule. And any trade which you take, which is in opposite to that particular thumb rule of the market, carries an inherently higher amount of risk. So the risk is gonna be higher when you take a counter trend trade. I'm not saying that you cannot do it, but the risk element is gonna be higher, and I'm gonna be walking you through where you can take that counter trend trades also. But to begin off this session, let's have a clear understanding that when price trades below the VWAP, the seller is in control. Okay. Next, what you do is you look at the bar. Let's look at this particular bar, which started at 21,950 and it ended at 21,860, and this is a 30-minute bar. Okay. Now what I'm doing is immediately I'm taking my focus to the green line of the bar, and this is going to be a dynamic line. It is going to keep moving as price moves, and every time price moves, volume comes into the market. Okay, we say it's a volume weighted average price. This green line is going to keep moving. Okay, but can you apply the same logic over here also to this particular bar? And can you now say that if you were looking for a put, you'll wait for that price to come below the VWAP and then initiate that put? Can you do that? Yes, no? Same rule of thumb. Okay, you are looking to take advantage of something called timing the market, and because you now know that price is below the VWAP of the bar, okay, you are looking to buy puts within the bar within that 30-minute time frame. Now, can you do this, okay, in a 3-minute time frame also? Yeah. So if I go into a 3-minute time frame and I look at, okay, what this market, okay, is doing in a 3-minute time frame, I'll draw up a full screen, okay, 3-minute window. So if I'm looking to initiate, okay, in a 3-minute time frame, I'll be looking, okay, to do it, okay, below the VWAP, okay, in that 3-minute time frame also. But this is more because, okay, it's a more dynamic indicator. You can, okay, utilize it a lot more, okay, in the 30-minute version of the market, right? Now this is the day profile and this is the 30-minute profile. You can also have a look at this in a weekly time frame setting also. So what I do is I always make it a point to find out, okay, what the market is doing relative to where it was trading in the previous week, right? Now, again, this is a weekly profile, right? And this is the VWAP of the week which has gone previously, level to around 22 to 260 270, okay, is the VWAP price. Price is trading, okay, below that VWAP price for the first 2 sessions of this week. Can we now again say, because of that rule of thumb, that the seller is more in control over here? Only because, okay, the rule of thumb is obeyed, that the sellers control the region below the VWAP line, right? Are we clear up to here? Okay, I'll pause. Okay, if there are any questions, okay, I'd like to take it in. So the question is, so when block shifts down, it signifies that shorts are booked out, or how to find it out? So when the block shifts down, okay, that question, okay, can be answered better through an order flow chart. Instead of playing guessing games, it's best, okay, to look at an order flow chart and see what moved the block down. So within an order flow chart, you will always know where the buyer is and where the seller is, and whether it moved down because of a higher percentage of buyers or because of a higher percentage of sellers. So I hope, okay, that answers, okay, your question about what really happens. And because, okay, this is dynamic data, okay, this data begins at 9:15 a.m. and it ends at 3:30 p.m. in a particular session. It's the volume keeps flowing, okay, and the information, okay, keeps moving, and the volume of the market is huge. So don't just go, okay, by what happened at 9:15 and try to, okay, devise a bias at about 11:15. Look at the entire period between 9:15 and 11:15 and then arrive at a better decision on what to do. Okay, so the question is, okay, sometimes price breaks VWAP from down to up and hits stop loss and then comes back. So now that is a typical, and actually it's a general statement. Okay, we have not devised rules, okay, on where we are gonna keep our stop loss. So my stop loss is very different, okay, from your stop loss. It's got something to do with a trading strategy. But know one thing, because, okay, this is a general discussion and we're not going to get into specifics of the kind of trades, okay, we take. Know one thing, when it comes to VWAP, VWAP is the zone, okay, where the average price of the market is. And a lot of big institutions, they wait, okay, for VWAP to come to place their largest trades, because at VWAP, you get the best condition or the best atmosphere, or the best environment to get your trades at the most perfect price, right? So when you see a lot of VWAP trades going on, those are your big institutions, okay, who are putting in those hedges. It's much more easier for me, okay, to take say something like a short future or long call as a hedge strategy, or a spread at a VWAP, because, okay, I know, okay, the liquidity is there a lot more at that VWAP price, and I know, okay, that the volume is enough, okay, for me, okay, to get a fill on all my trades. So around VWAP, okay, you will get a largest sum of trades, okay, going on. So that's why, okay, when we're looking at VWAP, we have a saying at VTrender that we do not consider VWAP to be a line. Okay, we consider this to be a zone. So when I say VWAP is 22,116, It does not mean, okay, that price is gonna be violating 22,116 and my stop loss is gonna be taken out. So if I want to keep my stop loss, I'm not gonna keep it at 22,116. I'm not gonna keep it at 22,117 also. I'm gonna give it a 10-point filter because it's not a line. It is a zone. And remember, it's the average price, and this, okay, will keep changing as volume, okay, moves up and down, right? So that's the number one, okay, number two takeaway I want you to take out from today's session. Don't treat VWAP as a line, treat it as a zone and allow for trades to happen over here. When we come into the market, we come with very absolute concrete definitions about the way, okay, we are to trade. But understand one thing, okay, about the market. The market is a floating living organism. Okay, it is made by people like you and me and millions of people like you and me. Okay, it does not mean, okay, that just because somebody drew a line on the market in the sand, okay, the market is going to come touch that line, it's going to get an electric shock and move away. It doesn't happen that way. There are a lot of trades, okay, which happen, and all trades are independent of each other, and prices, okay, will keep probing up and down, right? And prices, okay, have to move up and down, okay, to fill, okay, the amount of limit orders, okay, which exist at a certain price. So price, okay, will probe zones. So you will say, okay, my stop loss is about 300 on my particular option, but many times, okay, it will come up to 301, touch it, okay, fill all the orders at 301.5 and come down, okay, below 299, 298 also. It has to absorb all the liquidity which is there for the auction to complete, right? So that's why, okay, don't be very concrete, okay, about these things. This is all general stuff, right? Now, when it comes to VWAP, the biggest use, okay, I found in VWAP is we're going to be spending some time over here. The biggest use I found in VWAP was in option charts. So just to bring all of you up to date, we now, okay, have this new addition in our menu option, that is the line charts, in which you can get a visualization like this and up to the last 6 days. Now what I do is I use this a lot to find I think I got disconnected. Can you guys hear me still? Am I live again? Okay, small internet related issue, but I think I'm back live. Okay, so what I do is I use this, okay, we have this feature, okay, which we added, okay, which is called line charts, and you can click on it, and we use this a lot, okay, to trade options. So like instance, okay, today just give me a minute, guys. Okay, my system is still coming back. allow me a few seconds more. My system, okay, is just switched, okay, to the other network. So I just need to give it about a couple of seconds more, okay, for it to come back. Is my screen up for everyone? And am I audible? Am I audible again? Can I get a few yeses just to confirm that? Yeah, all good. Okay, I apologize, okay, for what really happened. Okay, my system, okay, went, okay, from one net to the other net and then came back, okay, to the first one. But yeah, let's get on to it. So I was, okay, speaking about the 22-100 P, the line charts, okay, which we have. Now what we do is, I just want to point out, okay, a few things about the way, okay, we use VWAP in option charts, and how best, okay, we can utilize, okay, these information. So I'll clear this chart up, and what we get over here is, if you go into this menu, you can pick up, okay, any particular option, okay, which you want to trade. And again, okay, when you see this green line, this is basically, okay, the price of the movement of the price, and I've cleared out all the information and I've just added the green line on the screen, and green is VWAP. Okay, in all our charts, market profile, order flow, wherever, okay, you see a green line, the color, the font, the color green, you would get the volume weighted average price. Right now, again, okay, let's use that same definition. If price stays above VWAP, who is in control? Buyer. So in this case, we're looking at the 22-100 PE, and all through the morning we were looking at buying the put, and this price has stayed above the, this is an in the money put, okay, we took, okay, right at the morning at about 9:20, 9:25, because of order flow data in the Nifty right at the open. But in this case, price has stayed above VWAP all day. It is came back, it tested VWAP and has stayed above VWAP. So now, because price has stayed above VWAP all day, who is in control? Who is in control? Buyers, right? So does it make sense, okay, to be a buyer in a deep in the money put, because, okay, the price is above the VWAP line, right? So that's one way of looking at how to pick up information from the volume weighted average price. The second thing, okay, which you can do is, there will be some traders, okay, who will always tell you that there are instances in the market where you can plan a mean revert strategy on the VWAP. Right now, like I told you at the very beginning of our conversation, the VWAP changes meaning depending on how much volume is coming above that line or below that line. Right, so if the volume is coming above the average price of the market, more volume, okay, the VWAP, okay, tends to rise. And if more volume has come below the average price of the market, right, then the VWAP, okay, will not rise. But there are conditions in the market where the market, okay, reaches something called the 2 standard deviation line of the VWAP. Now again, this is a volume dependent dynamic line which you can have in all of your market profile charts also. Okay, and you can find it out by these little, okay, pink lines, okay, which come up over here. So like what you have on your screen right now, okay, you will see something called a 2SD down at 21,869. And this is what we call the 2SD, as in two standard deviations of the VWAP line, which is placed at this particular number of 21,949. Now, what is this 2SD band? Okay, this 2SD band is a classic way of looking for a mean revert pattern in the trading session. Now, think of the 2SD band as your Bollinger Bands. Okay, so I'm sure, okay, all of you are familiar, okay, with the Bollinger Bands, which work on that 20-day scale. And you know, okay, when price, okay, goes up, okay, to a certain level, okay, you can above the Bollinger Band, you know, okay, that the market is overbought over there, and you look, okay, for the price, okay, to come down. That similar example can be used, okay, in a VWAP strategy setting, where, okay, you're looking at plotting 2SDs through the day. Now, these lines will not change if the volume is high. All right, so bear in mind, okay, when I said volume weighted average price, if the volume is increasing, the VWAP is going up, and that's why VWAP, the 2SD of the VWAP, okay, will also keep rising. But there would come a situation in the market where price just about touches the VWAP 2SD band, like this particular pink band over here, and you have to watch, okay, the 2SD band over there. And if the 2SD band does not move, okay, that means there is no added volume coming into the market. And if there is no added volume coming into the market, that sets up a condition for a mean revert trade. So if the price is around here at this 21,869 level, this will set up a perfect condition for you, okay, to go and take that trade halfway to VWAP or back to VWAP. So if you are looking to long the market below VWAP, okay, the best place, okay, where you can long the market below VWAP is going to be nearer the 2SD line. If you're looking to long the market below VWAP and choosing any random place to go long, your chances of probability of success, okay, based on just this VWAP strategy is 50-50. And we do not want to do any trades which have a 50-50% probability, because 50-50% probability over the period of about 1 to 2 years, okay, would wipe out your account completely. However lucky you are, okay, with your 50-50 chase, 50-50 is not the kind of probability, okay, you want to take when you're taking trades. You want to look for setups, okay, which are giving you that 70, 75, 85, 90% probability trade also, right? For instance, okay, today we had a classic, okay, seaside trade, and I've talked to you a lot about what the seaside trade is. And I was, okay, doing a live audio session, okay, with my VMR classroom today, and I told them, okay, that this particular PE, the 22,100 PE, was gonna go to a price of about 286. This was in the C period, and at that point of time, a large seller had just come into the market. If you're live on my Twitter, I've spoken to you about that large seller also, who came in, okay, in that market. In fact, okay, we can see them over here also. And this was a particular situation, okay, which came in and had about 90-95% probability of going in your favor. So it worked out, okay, some of the major, okay, things, okay, which were there. This happened in the C period. There was this largest buyer, okay, who came in here around 233. And we were looking for this particular trade, okay, and it became one of our 90-95% probability setups, and we got an immediate fill at about 250-55, and the trade, okay, went up to about 289 for a completion of the trade. And the reason being that the order flow showed that volume which was coming in was dominated more by buyers. As you can see over here, it was more of a buy side dominated trade. Right, so this is, okay, how you can use the information from VWAP to get better at the business of trading. Try to treat it as a zone, okay, where you can look for a particular bias, okay, to hold in the market. And this is that particular trade. The IB had come in, and the market, okay, moved up higher, okay, from that zone. This is that 1227 buyer, okay, who took the market up. Right, now just take two of these examples, and there are many such examples, okay, which you can always get, okay, when you're looking at VWAP. Right, now couple of things just to summarize, okay, what we've been discussing about VWAP. Okay, the volume in the VWAP is very, very important. Know where that volume is, and you have to look at this volume zone to know where the volume is coming in, right? So we have these green bars which come up, the volume profile on the left of your screen. If these are heavier above VWAP, that means this VWAP line is going to keep rising. But if these are heavier below the VWAP line, that means the VWAP is going to be flat. A flat VWAP market, a flat VWAP is also a flat market, and a flat VWAP is used by a lot of institutions to generate hedged trades or short gamma trades for themselves, right? A VWAP which is rising is a sign of more aggressive buying coming into the market, and a VWAP which is falling is a sign of more aggressive selling coming into the market. When you're plotting VWAP, you can plot the two standard deviations of VWAP, and you can always use the two standard deviations of VWAP to know how much the market can move from a particular zone, right? So for my Nifty chart, and this is our daily profile, what I can do is I can plot it across a series of prices also. So if I go over here and if I want to create something called the VWAP, I can choose the anchored VWAP, the 2 SD bands, and the date I want to set is from the 11th of March, where this down move began. This is the profile, and I can just give it a title and give it a color, and there now I know just by using this formula the market is below the A VWAP, the anchored VWAP, and it's at 22,210, which at the close of today, and potentially this market can still drop to this 2 SD band, which is about 21,812, right? So this is how you can interpret trades based on the information the VWAP is giving you, right? Now this particular part was about the VWAP. Now let's move on to what we call the VPOC, the volume point of control. Now the volume point of control is this particular pink line on our charts, which by definition is the zone in the market where the largest volume was traded. So VWAP is average price. VPOC, volume point of control, is the largest zone of volume in a particular session, right? Now I know a lot of you would have heard different definitions of this term VPOC, but today if you want to listen to me and you want to carry one single element of the message with you back home, just think about VPOC is equal to largest. That's all I want you to take away from here. Forget about what everybody else has been saying about what VPOC is, but whenever you think about this word VPOC, think about it as the largest concentration of volume, or the area where the highest volume is traded. Now isn't that a powerful information for us to take trade out of, right? So we are all used to a lot of volume below the bar, and we always say when volume below the bar is high, that means more volume was traded that day. But how about shifting that entire definition by 45 degrees, and instead of looking at volume below the bar, find out a zone in the day in the bar where the volume was highest, right? So instead of looking below, you're looking now at a zone where the market was trading the highest volume. So you are all used to looking at volumes below. I am saying look at volume which is highest right next to this particular bar, right? And if you can find this particular zone where you can find the largest volume of trade that day, you would immediately now make another bias about whether the buyer is more successful or the seller is more successful that day, right? So just to put this a volume profile definition to it, so you can have the volume profile right next to it, and you can see in all this entire profile which we've drawn over here, the concentration of volume has kept changing, okay? And whenever that volume concentration keeps changing, you immediately know that volume can only be by buyers or sellers, or somebody who's having both in, so a hedge player or somebody with a spread also. But if price stays above the volume point of control, you can say that the buyer at the largest concentration of volume is now more profitable. Okay, and if price stays below the volume point of control, you can say that the seller is more profitable and is in more control of his particular trade, right? You can see this in a profile chart. You can see the same pink line in a order flow chart also. So you will find these particular boxes coming up over here. Those are your volume points of control where the largest concentration of volume is. Now we can use the same rule when we are getting into trades within that particular bar, and within that particular bar, whenever we cannot give the color pink over here because there are a lot more buyers and sellers depicted by the green and the red of the bars over here. That's why it's a yellow box, rectangular box to come in to depict the volume. But if you're looking to make a long put case, thinking that the market is gone, it's best to initiate that trade below the volume point of control, right? So there's a chance that the market can go up that way. So together, if you see the VWAP and the VPOC at both points together, you can get a fairly good idea about what is the bias the market is taking in that particular day, right? I'm going to pause here. If you have any questions, please feel free to ask me over here. Any questions? Looks like there are no questions at all today. Okay, so do you see the current, the question is, do you see the current day VWAP or yesterday's VWAP? We see both. We see both. So if price of today is trading below yesterday's VPOC, who is in control? If price of today is trading below yesterday's VPOC, who is in control? The seller, right? So every time you see that the market is below the previous day's VPOC, look to have short calls or long puts in the market. Okay, the question is, how can we know what is a failed auction? There is a detailed explanation on the failed auction. This is not the topic for today's session. If you want, we can do a few sessions on failed auction later on also. Try to stick to our conversation today, guys. Let's keep the questions relevant to what we are discussing over here. So again, the question is, how to plan entries after big momentum candles. There are a number of ways, you can do it. There's not just one way of doing it. It's a more general discussion. It's not in line, with what we are discussing over here. Right. So I hope, you are getting the gist of what I am speaking out above over here. Just try to carry, one thought with you. If you're seeing VWAP and you're seeing, the current price, you have to understand, what is the bias of the market then. And if you're seeing VPOC, and you're seeing current price, again, you have to see. Now, what we are doing is, we're trying, to converge this information. So I've spoken to you about what VWAP is, and I've spoken to you about VPOC is, and they have similar set of rules. And the set of rules are, the buyer is in control above VWAP, and the buyer is in control above VPOC, and the seller is in control below VWAP to a certain extent, and the seller is in control below VWAP. Now let's combine it. And let's see how best we can use it. So what I do is, I always like to look at these charts when I'm trading the options, and here you have the VWAP and the VPOC over here. Now if I plot this as the VPOC of this particular instrument, which is the 22,000 PE in this case, right? And I've looked at the 6 days, and I'm quickly making a note. I don't have any other information in this. I'm quickly making a note about where this pink line is gone. and at what time it is gone. Okay, and beyond all that you know in the market, now I know, okay, that this particular market, this particular instrument worked up to this level on the 14th of March at 12 noon, and this was around 180, right? Okay, and it came up to this level, it was around 160, and this VPOC level, okay, came up to 140. Now these are my most important reference lines in the market, right? These are my most important reference lines in the market, and allow me to explain why I say so. Now this is what, so if I want to zoom out, zoom in, I can do that. Now what is this pink line telling you? This pink line is giving me a historical perspective on where the largest concentration of volume of trade happened at that particular day. Not below the bar, at the bar, and it's giving me one accurate price, which in this case is 175 rupees. Okay, and every time in the next few minutes, okay, the market, okay, went up over there, it saw resistance over there. So I can now conclude, without even looking at an order flow chart, that this particular line, there is a seller who's acting up over there, right? So just by looking at this particular line at 175, and the fact, okay, that 2 days later it got supply over there, it's telling me, okay, that this market, okay, found supply. And I'm now looking to see in my order flow chart the next day if this market wants to behave above 175. And today was the first time it went above 175 and it rose up to about 220. That was an easy move for us for about 45-50 points, right? Again, I'm looking down over here and I'm seeing, okay, that there is a VPOC line here around 70. Okay, now this is market generated information, right? It is given to me by the market, and it's telling me that at this level of 70 on the 14th of March, between 11:58 and 3:30, for about 3 hours, the market put in the large amount of volume at about 70. And the next time the market, okay, came back over here was on the 18th of March. Again, okay, it touched this level of 70. And I told you it is a zone. It's not just a perfect line in the sand. And it bounced off that level. Now, why did it bounce off? Because, okay, there was a previous buyer attempted here at this zone. And you can always look up this information for verification in the order flow chart. And you will see, okay, that buyer, okay, in that chart at 70, if you go and probe lower also. Right, so I let you, okay, do that. That's your homework, okay, to go back into the order flow chart and look at that information and see, okay, how the buyer is acting up at those prices. But every time, okay, it crossed it, you can say, okay, that the market, okay, was getting fresh demand or fresh supply over here, right? So this is that buying, okay, I'm talking about right here, 12,000 lots, 10,000 lots. This was that buying, okay, which was coming in, and the market, okay, was driving up based on this. The COT, okay, also went green over here. But even if you do not have this order flow information, a quick look at just these line charts will tell you what the market is doing up over here. Now, I know, okay, a lot of you are open interest experts also. So to the same chart, let's add more information. So now I know that 70 rupees, okay, was a nice support. Let's look at what really happened, okay, with the open interest over there. The open interest did not, okay, confirm the same thing to me. Let's look at what the open interest spike was. Nothing much happened over there at that particular price, but something was happening over here, okay, as the market, okay, was getting in over here. So these people, okay, were writing over here, and there was a chance, okay, that they could get toppled if price moved above this VPOC line. Are you following, okay, what I'm trying to tell you? If you go deeper into this, okay, you can get very clear signals, okay, for you to make informed trading decisions out of. So what we are saying over here, trading is not something, okay, which you do randomly. It's not like throwing darts, okay, on a wall and it's like chipka to chipka and gaya to gaya. That is called random trading. That's a 50-50 tossing a coin in the air kind of probability. You want to work with data. You want to work with information, and you want to go, okay, back to the market to find out what the market has done at a particular zone in the past. And this requires work. And if you're willing to do this kind of a work, okay, then the market, okay, is going to open up lots and lots of things, okay, for you, okay, to explore out of. right? So this is open interest data added, okay, along with VWAP and VPOC. Okay, I use the open interest data only to find out if the traders are going upside, up and down. But this information itself is a gold mine for you to find out accurate levels where the market is telling you that this particular zone is important. It is not a derived formula of the A plus B plus C divided by 3 or 4 or 5 types. It is market generated formulas, market generated information, and confirmed with the presence of volume, which is actual traded size entered into the market. So if you start working with these kind of levels, which are given by VPOC, you'll have a better chance of getting good at trades, right? So you can, okay, keep looking at any particular strike if you want, but choose a strike, okay, you're trading with. Don't just go randomly, okay, into a 22,100. The reason I put up 22,100 PE and 22,000 PE because I was actively trading with that strike today. But you can choose, okay, whichever strike, okay, you're trading with. The information from the market is going to be the same, right? So I've taken a 21,900 PE and the same information is over here at 135. The market has found resistance 2 days back, right? So that's how, okay, you look at the chart, okay, and this is something, okay, which you have to do as part of your homework at the end of the day for you, okay, to take proper trading decisions out of. Don't leave it to the wind. Don't leave it, okay, to the whims and fancies, okay, of other traders in the market, but have a concrete plan in place, have a concrete structure in place, and understand, okay, what the market wants to do at a particular level at any point in time, right? I have a few minutes more. If you have a few questions, please, okay, feel free to ask. The pink lines are the volume point of control. They are zones where the largest volume was traded that day. You guys, okay, have got Google. You guys have got ChatGPT. Okay, you guys have got Llama, Bard, Gemini. Go and look it up. Okay, it's powerful information, okay, which you should have, okay, as a trader. Yes, you have, okay, these for straddles as well. So to plot straddles, okay, you can go into your options table. By the way, guys, for those, okay, who have not been used to our options table, all the strikes now, okay, we have the VWAP and the VPOC, of course, over here. In for all the strikes, the VWAP, VPOC, okay, which you show here, you'll get it at one glance, okay, over here. This is for all the calls. The VPOC is in pink, like I said. The VWAP is in green. And for the puts, okay, you'll get it over here. VPOC, VWAP. And now, okay, we tell you, okay, which strike, okay, is dominated by buyers and which strike is neutral, etc. So S means dominated by sellers or writers, and B is, okay, dominated by buyers. But if you come back, okay, to this options table, you get a one look understanding of all that is happening in the options market just by focusing on this VPOC VWAP line out over here, right? Every time, okay, you see, okay, the LTP, the last traded price, is above or below this, you immediately know, okay, what you need to do. If you want to go and delve deeper, you can pick up the order flow chart as well. Okay, the question is, what is the average volume for Nifty per day? Okay, it's a dynamic market. Even if I tell you the current figure right now, you would find, okay, that the market, okay, has difference. See, I've started trading, okay, at a time, okay, when there wasn't a lot of volume in the market, but now, okay, that kind of volume, okay, gets traded in 1 hour. Okay, what used to happen previously in about 4 or 5 sessions. So the volume in the market, okay, is keeping. So always remember one thing: everything in the market is relative. Don't go with set numbers in your head and say, okay, that this is it and this is finite and there's nothing above this or below it. Be dynamic, be open to change, because that market is like that. It's a living organism. It's full of life, it's full of energy, it's full of vigor, and it keeps moving. And you have to, okay, keep syncing, okay, with the moves of the market, right? So whatever volume, okay, you're used to it, know one thing: it's going to keep rising, okay, as the years roll by. So how to make this continuous VPOC? Okay, you can, okay, get it on the line charts. We have done it for you, so you don't have to do any work for yourselves. Go into the menu, go into the menu option, go into line charts, and number of days, okay, you can choose 6, because, okay, we focus on the weekly profiles, and there, okay, you'll have the largest concentration of volume as a pink line all over the chart. Use it a lot. okay, and it is going to be definitely more helpful for you. Okay, any closing questions? So there is a recording of this, okay, available on YouTube. I know, okay, that some of this information which I may have given may probably be new to some of you. Okay, we are open, okay, to have all kinds of questions. Ours is a method, okay, which believes in information sharing. I do not lose anything, okay, by sharing this information with you. Okay, in fact, okay, it clears a lot of bad elements, okay, from my life, okay, if I share, okay, more information with you. And we are an open system, okay, of sharing. These charts are available, okay, also for you to trade with, to utilize it. Okay, we have free access also available, and our plans, okay, start with only about 300 per month plus GST, of course. And if you want to look for upgraded features like order flow, etc., there's an additional cost to it, but you can always, okay, utilize some of our features for free for as long as you want. And when you get confident, you start making money, okay, you can always think about, okay, going in for a premium plan. It's only about 300, okay, that's the cost for a can of beer or can of coffee nowadays. And for 1 month, okay, I think, okay, it's the minimum, okay, you can do for yourself to support your activities in trading, right? So that's it for me for now. The Premium Plus, of course, okay, is going to give you a lot more in terms of the additions which are there. Most of the things, okay, which are there in my menu, you will not find it in a lot of other chart providers. We have worked, okay, and we've created a boutique which is giving you information, okay, which we pride ourselves on, and we know that some of this is not freely available outside. So the order flow, the gamma, the spectrum, etc., that is part of Premium Plus. Only if you want to explore and you're looking for a bigger edge, you can consider this. It also supports order flow with a quick, okay, add-on. Okay, this is the cost, okay, for getting an order flow. An order flow is a potent tool for you, okay, for your decision making. If you want, okay, more ground, okay, to be covered in order flow, we can do a complete session on that as well, right? So with this, I will call this session to a close. I hope, okay, you found it insightful, and I hope, okay, you take some value out of it. Just to summarize, we spoke about VWAP, and I spoke to you about what kind of a bias, okay, to take when you're talking about VWAP. And remember, there's something called a 2SD band. So just because, okay, you're trading below VWAP does not mean, okay, you'll keep trading forever below VWAP. There is a push and pull effect. It's a rubber band, okay, it goes, okay, to a certain level and it keeps coming back. Then we spoke about VPOC, and I want you to remember VPOC as the largest or the highest concentration of volume. That is all that is. So what you do is, instead of looking at volume below the bar, you look at the area which has got the largest volume right next to the price bar. And if you see, okay, price trading above it, then the buyer is in control. And if you see price trading below it, the seller is in control. You also can plot historical VPOC lines like I just showed you, and use that information to get better at the business of trading. Don't choose random levels, okay, for your support and resistances. These are classic levels, okay, which I've used for a number of years, okay, to get a firmer edge in my decision making. So utilize, okay, these pink lines whenever, okay, you see them in your Nifty, your Fin Nifty, your futures, your options, wherever, okay, with whatever you're trading, go back, okay, look at these line charts, pick up the VPOC lines, look at what the market has done in the past 5-6 days, okay, and take proper trading decisions out of it, right? I leave you to do your own homeworks and to get better at the business of trading. If you have any questions, feel free to ask me. Okay, I'm at support@vtrender.com, contact@vtrender.com on my Twitter or on our YouTube. We are welcome, okay, and we'd like to hear your questions as well. Thank you for listening in, and I'll see you in another webinar sometime later, right? Thank you.